Welcome, everybody. Welcome to the call, the bank failures call. And I'm going to go to the start here. Technical issue. We've had to redo the first few minutes of the call, but hopefully it's the same message. So if you're watching this again, you might see slightly different haircut. But anyway, Silicon Valley Bank, Credit Suisse Bank, we've had 2 US failures, 1 European failure. Why this is not 2009, but it does have important implications for us going forward. So here we are, the headline: Silicon Valley Bank fails after run on deposits. And just to clarify, run on deposits is if you're a bank and Silicon Valley was losing some money on the investment side of their account. We'll go through that in a bit, but the speed at which somebody on their phone can move money around, $40 billion left in a matter of 2 days. And all of a sudden there's a ratio from a bank, and that ratio has to be deposits and loans. And if your deposits evaporate and you still have the loans, then you're technically insolvent. So again, bankruptcy there. It has been sold, but the shareholders were wiped out. UBS to buy troubled Credit Suisse and broker deal. Again, shares wiped out. People with loans at Credit Suisse, you still owe the money, but that bank was wiped out. Okay, so a lot of questions, a lot of people calling in. What does this mean for me? I'm going to just comment briefly. Board signals endgame at Canaccord. Unfortunately, this was very, very poor timing on the title of the article, because the end game was simply referring to the way it's playing out with the takeover. And I'm not going to comment too much on that. That is not, Canaccord is around. We're not going bankrupt, and nothing changes there. I would say that I can tell clients that LePoidevin Group, our team, our traders, we will not change our way we do business, whether we are in the hands of private investors or we're publicly traded on the market with many shareholders, whether there's a few or many. That does not change. The question then becomes is what happens in the crazy event? Now, first of all, I would say that we cannot have a run on a bank. We don't have credit cards. We don't have mortgages. And as a result, we're not in the same position as we can't have all the checking accounts. We don't have checking accounts. We are brokers. We broker in investments in stocks, bonds, and foreign currency and things like that. And that's what we do. So what happens? Now, first of all, I think it is extremely unlikely anything would happen, but let's talk about what does happen. Now, first of all, we have printed up here one of our staff members' registered education savings plans. And in that plan, you can see on the far left, BCE preferred. We've mentioned that many times in our call. We put our money where our mouth is from staff and clients. But you can see that there's 200 shares there, and it says SEG. SEG is segregated, separate from the assets of Canaccord Genuity. So they are not held in the same book of record as our trading desks and our own personal trading. They're held separate so that there's a ledger of who owns what shares. If you look at the last page of our client statements, you see registered accounts are held at Computershare. Accounts holding or transactions in negotiable securities. Negotiable securities are things that trade at different prices, like in other words, the stock market, are held in trust for you by Canaccord and are denoted by the segregated in your statement. So just to be really, really clear, we're happy to go through anybody's statement if they want to get it, because when you look online, you will not see this. When you look online, you're not looking at your monthly statement. This is a monthly statement. Segregated securities held outside of our own capital of the firm. Segregated securities are not available to creditors. Okay, they're outside. They go with you. If a brokerage firm in Canada, and again, Canaccord has been around since 1950. I expect us to be around in 2150. But Segregated securities are not available to creditors. You know, at the end of the day, if there was a cease operation at a Canadian brokerage firm, you simply move those segregated assets. I will also tell you that there's a double protection. And the double protection is, let's say one of our clients buys a share and there's 2-day settlement, they send cash in, and there's a bankruptcy during those 2 days before it's segregated. So you've bought it, but it's not segregated. This would be extremely unlucky. But I will tell you that the backup protection is a Canadian Investor Protection Fund. Anybody that wants a brochure, we can email them the brochure. Canadian depositors also have, in addition to their segregated securities, an additional $1 million per holder. So a husband gets $1 million, the wife gets $1 million, the registered accounts all get $1 million of protection of their unregistered securities, unsegregated securities, or their cash balances. So I think, you know, at the end of the day, we don't typically hold $1 million cash positions. We put them in a government treasury bill. We put them in something. We put them in stocks. So look, we have risks of the stock market. We're always worried about that. We watch the Dow, we watch the S&P, we govern your investments. But I don't want anyone to lose 1 week's sleep one night's sleep, because they're also worried about their shares held at Canaccord Genuity or RBC or Gluskin Sheff. None of that is at risk. So that's all I have to say about protecting Canadian assets, and we'll go into the slides about where we are in the interest rate cycle.
Let's talk about what rates have been doing. So we had the rates going up in the up until the 2007 peak. We had the U.S. financial crisis. Banks failed. Rates got slammed to zero. You can see rates were going up pre-pandemic. We had the pandemic. Rates went down, 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 and now we've had one of the most dramatic rate increases as inflation surged. We've talked about it in some of our other calls. Rates surged as we printed money and handed out free checks. We got through the crisis, but the consequence was higher inflation. So rates have gone up and up and up. So here we are. Now I'm going to talk about the silver lining of bank failures, and that is that the US Fed typically will not stop raising rates until something breaks. So the good news is we've had 2 US bank failures, and the question then is, are these bank failures atypical? The last time we saw, quote, bank failures, according to the consensus, is 2007. We had a huge crisis. Here's going back to 2000. The number of US bank failures on an annual basis. Okay, so here we are, 2023, and we're at 2 so far. And this represents just over 860 days since our last failure, which is the longest stretch in many, many decades of not having a US bank failure, which the previous record was 660. So it's been a long, long time, and there's a little bit of a panic. But if we look back, 2020, which was the pandemic, okay, there was 4 banks failed. Well, before the pandemic in 2019, there was 4 banks. And if we look at, 2017, 16, you look at the massive amount of bank failures in the 08, 09 into 2020, 2010, 2011. But even if we look back, 2000, 2001, 2002, those were very, very good years for our client portfolio. So let's remember that bank failures are almost a regular occurrence. And the silver lining, first of all, we don't own any of these shares of Credit Suisse or Silicon Valley Bank. So no effect there. Now, of course, people worry, is this systematic? Does it create problems in the US bank? So the answer is yes, it does create some problems. But the silver lining is, so if you're a bank and we're management of bank, there's probably going to be a meeting. Guys, how's our risk? What are we doing with our capital? What are we doing with our loan portfolio? And these meetings are going to be happening. I can guarantee there's hundreds of them as we speak. So the Fed's job is to slow the economy down and deliberately try to slow it and slow inflation with a slowing economy. The good news from our perspective is that a lot of the Fed's work is going to get done in the boardrooms of the banks. So they're going to be a little more cautious on their loans and what they do with their capital than they were a few weeks ago. And we can see what a yield curve looks like. And the yield curve is a chart of term and interest rates. And you can see that the Bank of Canada, we're at 4.5 on T-bills, and you've got a 2-year bond well below 4, and you've got a 5-year bond at about 292 today. And it actually bottomed on Thursday at 275. So rates are starting to go back up again. But what this says is the bond market is signaling that rates have peaked and they're going to come down. Now, there's a debate whether the US Fed goes one more time, but there's no debate whether they're going to go up and up and up and up from here. And, again, that's a picture of the yield curve. Now, again, a normal yield curve is one that slopes upwards from the left to the right. So normally, short-term rates are lower than long-term rates. So you can see the market has priced in, and you can see yields are actually upward sloping from 6 to 20 years, and then pretty flat from 20 to 30. And what that's saying is that interest rates are going to come down to the 2.5% to 3% level. But there's nobody out there saying that rates are going up, and no one out there is saying rates are going to go to zero. The bond market, this is what the bond market is telling us. And we'll talk about this in a moment. So this is a chart of the Bank of Montreal bond aggregated, all bonds in Canada. You own that. It's an ETF. It's the bond market version of the S&P 500 or the Toronto Stock Exchange Canadian bonds. And you can see as we have been avoiding the bond market, you can see the downward slope of bond prices as rates had gone up. But, in January, I said I thought bonds were still unappealing. But I said, I think that the major sell-off in bonds has happened and will probably tread sideways. And you can see that, in kind of early November, you could see the bonds had reached their lowest price. And that was with the optimism that the economy was all good. And then by December, we were, oh my God, we're going into recession. Bonds went up in price. And then we're not going into recession. Bonds came down. And then we're going in, we're not going in, and then Silicon Valley Bank happens, and then you could see bond prices had moved up again. Well, today bond prices are down about 1%, and this was a Friday chart. So we're heading down again because maybe at the end of the day, people are beginning to realize it's not systemic. I'm going to talk about Silicon Valley again just for a moment, because Silicon Valley Bank failed for a different reason than bank failures of 2009. 2009, every bank had exposure to subprime lending, or almost every bank. And that was a big problem that was embedded in the US economy and the fabric of lending. Silicon Valley Bank decided that interest rates are zero and they could make some money by taking all their checking accounts and moving them to bonds, 5 and 10-year bonds yielding 1%. So that worked for a little while, and then the value of the bonds dropped, as you can see. And so they took a massive loss. Word kind of got out there. There was a run on deposits. So the bank literally got shut down. Fortunately, this happens every interest rate cycle. Every interest rate cycle, people are going to take some of the low money. They're going to buy high money. They get burned. We saw even municipalities. We saw almost the county of Los Angeles almost go bankrupt in 2009. It happens. It's a consequence of rising rates. But again, we don't see a peak in rates until something breaks. And the good news is we're starting to see that bank breaking. As rates went up, cash pours into U.S. money market funds and amidst bank turmoil. And again, we know as investors that money, we talk about this in our calls, money has to go somewhere. We were starting to push on cash paying 5%. If our long-term goal is, which is where most people are, 7 to 10, 5 is not that far off. So when there's a little bit of turmoil out there, you can see cash pouring in. Again, is this cash sticky? Or as rates come down, are we going to see some of that cash move out? One of the clues that we do, and you guys can do this at home, this is the American Association of Individual Investors. And if you Google search or search AAII, which is the American Association of Individual Investors, they do a weekly survey of are you bullish or are you bearish? And you can see here that when the market was selling off in December, we had only 20%, this is December 21st, we had only 20% bulls and we had 52% bears. And that's about as negative as you typically see at the bottom of a market. And then you could see the market rallying, and you could see up here in early February that we flipped. We went 37% bullish, 37% neutral, but only in that February where we're in bearishness, only 25%. And you can see people getting, that wasn't an extreme number like the peak of tech bubbles. But at the end of the day, you start to get people piling in, and now we're, oh my God, we're going into recession, banks are failing. And I like to talk about, the level of a swimming pool. And if there's 100 swimmers and there's only 2 or 20 of the 100 in the pool, and there's a whole bunch of people on the deck, eventually more people are going to go swimming, the water level goes up. And when you see a record number of people on the deck, the water level being the stock market is as low as it's going to go. And as everybody jumps in the pool, the water level goes up. So, these current reading, here we have banks failing and the US market stopped going down. So there's somebody out there that kind of recognizes that this isn't necessarily the worst case scenario. So, again, we've covered your Canaccord. Our bank failure is normal. Well, actually, they actually are. One of the questions that came in, and Mark's going to get into some more questions too, but one of the questions that came in, okay, if rates are going to come down, David, a lot of your preferreds are reset. So does that mean bad news for a preferred share that is going to come due in a year or two at lower rates? So I gave an example here. This is an Enbridge T, and you might own this one or you might own a different preferred, but a lot of the math is the same. Enbridge T has a $25 par value. That's when it was issued about 15 years ago or so. The current price is $15.30, and the dividend is 101.8. So that yields 6.65. Every 5 years, this preferred share resets. This particular one has a formula for the reset. Whatever on the day of its anniversary in June of 2024, we're going to get 2.5% plus whatever the 5-year government of Canada is. So the 5-year government of Canada today is 2.92% as we speak. So let's say rates are even lower. Let's say rates are 2% in a year and a quarter's time. Well, let's do the math. You get 2.5 plus 2%, let's say rates are 2. The dividend will actually go up. So we're very excited about our 6.6% dividend, but we're going to get a raise of over 10%. So our dividend is actually going to go up. At our price today, we're going to get 7.35%. If rates are closer to where they are today, at 3%, my God, we're going to be almost earning 9%. So the last time the preferred reset, which was 2019, again, there's a 5-year anniversary. If we look at the yield curve, the bond market is telling us rates are coming down, but the bond market is telling us we're not going to zero. Zero as the Great Depression, the financial crisis, and COVID. And let's remember that we have spent more time in Canada, more days above 10% than we have at 0%. So it's very atypical to see rates this low. So yes, rates are coming down, but it's going to be a win for people that own preferred shares. So if you again, you look back at our example that RESP, we've done very well in these. We will govern the accounts accordingly. If we see a better preferred, we'll trade it out. But right now, it's looking extremely positive for us to get exceptionally good dividends, and then most likely a price appreciation when these reset at much higher dividends. Okay, so some more housekeeping here as I power through this. I think that one of the lessons, again, is that banks can and do fail. Now, again, I know in Canada we've forgotten this, but Canada Deposit Insurance reviewing limits, okay? So right now they're 100,000, and the article states that we're exploring the idea of going to 200,000 because Canada has one of the lowest insurance limits in the world. And I would say that I remember a client who's passed on now, but he had maybe 40 or 50 different GICs because he knew I wasn't going to go over 100. This is a very wealthy individual, and he had $100,000 in, all the banks, the trust units. He didn't want to go up deposit insurance because he's old enough to remember 1991. I've been coming across clients that have, one client we came across, and again, not with us, $2 million at Duca Financial. Well, this is a credit union from Ontario that is not the highest lending credit quality. People, please don't do this. Interesting thing happened in Canada as well. If we look at the last earnings, they all came out and they all raised their loan loss provision. So the loan losses were near record lows. They've come out and they've said, yes, we acknowledge that there's going to be some problems with some lending. So we took them up a smidge. Okay, that's prudent. But we've only taken them up a smidge, and how much, as we know, I talk about housing, and Canada has the most amount of debt at the household level in the G20, it's going to be more of a problem than people think. But an interesting thing happened last week. 4 out of the 5 banks hit year lows, but one bank in question is at a 10-year low. So Scotia is trading at the same level as it was 10 years ago in 2013. And what's going on there? Because it's lost a third of its value. Well, in their earnings report, something strange has happened. And again, a bank is a black box. You can't necessarily go in and find out what was going on. One of the things that's offset the losses at the banks is something called net interest margin. And net interest margin means you take all the money that's sitting in checking accounts earning 0 return, and they can pile them all together. And when you add all the 2,000 and 3,000 we have sitting idle in our checking accounts, it can be in the billions. And they can put that at the Bank of Canada and deposit it and earn, right today, they're earning 4.5%. So that's a massive profit. Scotia came out and said, we have no profit increase in net interest margin. So like Silicon Valley Bank, they've done something behind the scenes in this black box to offset some massive gains. And I don't know if it's just the beginning, and I don't know the size of the loss, but I have come across a client with $1 million GIC at Scotia. And again, let's remember 1991. We had a half dozen fairly predominant bank failures, and it is not without question that it's possible that we have some problems. This fund is only 4 years old and 3 point something years old. And it is now the largest fixed income. This is an exchange traded fund, trades on the Toronto Stock Exchange with now $6.8 billion in assets. CI, Canadian Investment, which is one of Canada's biggest funds, high interest savings account ETF. And it's got 6.8 billion, and there was only 4 holdings in the account. Well, maybe, 0.3 and something else. CIBC, National Bank, Scotia, and Bank of Montreal. They actually just take their money and they park them in a high interest account at these 4 banks. But I want to point out that in the details of the prospectus or the offering memorandum, like most, I'm going to read this. Like most mutual fund, this ETF doesn't have any guarantees. You may not get the money back. Although the ETF primarily invests in bank deposits, the ETF is not covered by the Canadian CDIC, Canadian Deposit Insurance Corporation, or any other government insurance depositors. So people, we are going into a weird cycle. Central banks have all raised rates. There's going to be more things to break. So let's be careful. CI, Purpose, I see Evolve. There's a dozen of these entities. Don't invest beyond deposit insurance limit. If you really want to stay short term, buy a Government of Canada bond, 4.5% in a T-bill. Don't push like someone else has 4.65. Stick with a T-bill. You could have $1 billion into it. You're all deposit insured by the Government of Canada for the full amount. That's why the Canada Pension Plan doesn't buy these high interest savings accounts. When they have cash, they buy T-bills. So, okay, let's talk about the economic cycle. Again, I'll try to get through this as quickly as possible. One of the things you need for a recession, again, we've inverted the yield curve. Every recession is preceded by an inverted yield curve, but not every inverted yield curve leads to recession. An inverted yield curve is telling us that interest rates are going to go down. Interest rates can go down if you go into a recession. Recessions are deflationary. Mission accomplished. You go into recession, inflation comes down, you lower rates to stimulate the economy. So that's what happened in 2009. We had a recession, rates went up, and we had a recession. Again, subprime was embedded. It was a problem. 1991, rates went up. We had a mild recession. Stocks went down less than they have today. So that's a possible scenario. But let's remember the other side. We haven't had a recession since the 1920s. You need 2 things to happen before a recession in the United States. One is an inverted yield curve, but it needs to be accompanied by a rise in crude oil prices. When those 2 things hit the consumer between the eye, that's when you have a recession. But crude oil prices have done nothing for 10 years. They're lower than they were a year ago, not higher, lower than they were a year. So we're missing one of the key ingredients for a US recession. So at the end of the day, I would say this is the commodity. So crude oil, this is a commodity research. This is the S&P 500 of commodities. So you've got your base metals, you've got copper, you've got orange juice in there, you've got things that we need. So you can see the big spike as inflation, and we're much higher than pre-pandemic over here. But you can see that we're actually back to February of 2022. So commodities have stopped rising. They're up, but they've stopped going up on a year-over-year basis. So perhaps we found a new level of commodities. So we're going to watch this to see where inflation is going. We've talked about how, in my last call, that inflation was coming down. That's been a good call. And for that reason, Silicon Valley problems are unique to Silicon Valley. Credit Suisse is unique to Credit Suisse. It's not systemic in the US economy or the European economy. So therefore, we're still sticking to our forecast of a pretty decent year. It's been a good start. We took a step back under the banking crisis, and the markets are up today. Bond yields are back down, and we'll see. I think at the end of the day, it will pass. So again, our checklist for Canadian credit crisis. I've removed the CDIC. Don't worry about the big five banks. I've removed that. I think that there's no reason, even with a big five bank, you need to have more than 100,000 of deposit insurance. If they raise it to 200, you're fine. 200, the government of Canada backs you. So I've removed that. I still say investment properties, if you haven't sold, they're not going up, they're going to go down. Avoid mortgage investment corps. Please avoid the riskiest lenders. They've done very poorly in their share prices. Large Canadian banks are vulnerable. Like I said, banks have done very poorly of late. I think that the U.S., I think all banks are going to rally here because we've sold off on the Silicon Valley news. But again, in Canada, as we go through from earnings quarter to quarter, we're going to start to see loan losses mount. But I've added another one, and again, avoid high interest savings mutual funds. You don't need that. Make sure we're all deposit insureds on our cash. So that concludes my speech. The theme from the January is still intact. Love preferreds. We like good value stocks. Marc's going to go through some of the other questions real quickly because I'm over my time limit again, which I always do. But I'm going to pass it over to Marc. So thank you very much.
Okay. You want to bounce over to the golds chart?
Yeah. There we go.
So, a lot of the questions actually we came in around Canaccord. So David's talked about that. I won't touch on that anymore. Got a lot of other questions that were more individual about people's accounts specifically. I'll get into those and I'll get back to those people. So the only one I really want to touch on is gold. And we talked about this a few conference calls ago. And, there's a belief that for gold prices to do well, it's really just a matter of having inflation. And we talked about that not really historically being the case. What you need is inflation and really a negative real yield environment. We've kind of seen this play out over the last year. Anytime the Fed got really hawkish and dug in about driving interest rates higher and higher, gold didn't perform all that well. And if we look at the last few weeks, a month or so, when we've had Silicon Valley Bank happen, we've seen yields come down rapidly. We've actually seen gold perform really well. So just a reminder that while you need inflation, you also want to have that sweet spot negative real yield environment. And then we included this chart as well, just to illustrate that when you look at gold in Canadian dollar terms, it's actually been an excellent performer. So any other follow-up questions on that, or you want to get into a little bit more detail, feel free to reach out. But just to reinforce, how gold's done and what's kind of causing its movement over the last year or so in this higher inflation environment. Otherwise, I think you covered a lot of it.
Go through the gold stocks and how they are lagging.
Yeah, it's a good point. So gold stocks have really been laggards, and we've seen this dynamic play out before, where gold stocks have led at times, lagged. We have seen GDX is a sort of composite of gold miners pricing US dollars. So as we've seen gold move pretty well here, touching 2,000 an ounce. Recently, it's backing off a little bit today with higher yields, but gold stocks themselves have sort of have lagged that move. So maybe an opportunity there.
Good stuff. If we haven't got to your question, or you have more questions about got on mute. If you haven't got to your question, or you have more questions about your specific account, again, if you want more clarity on how deposit insurance, the segregated, if you're worried at all about your investments here at Canaccord, call us, because you shouldn't be. That's something, the stock market goes up and down. Let's worry about that. Do not worry that your shares in Enbridge Preferred are any way going to be taken from you. They cannot, whether we're an entity or not. They are yours, end of the day. So again, thanks everyone. Over time again, but look forward to the rest of the year. Thanks again.